Good Monday morning. Welcome to First Mover, your first global look at today's action in the Bitcoin, blockchain, and digital asset space. I'm your host, Christine Lee, and joining me are my co-host, CoinDesk Managing Editor of Global Capital Markets, Lawrence Luton, as well as Managing Director of International Content, Emily Parker. It is a full house. Welcome, Emily and Lawrence.
Good morning. Happy Election Day.
Nice to be back.
Back to have you. Great to have you back. Let's take a quick look at Bitcoin. The CoinDesk Bitcoin price XBX index is currently trading at $43,352. Bitcoin is down, pulling back about 8.4% over the past 24 hours. And the CoinDesk Ether price ETX index is currently trading just above $3,000. ETH also taking a hit, down almost 10%. And the new DFX, CoinDesk's DeFi index, is right now at $534. DeFi also pulling back about 12.2% over the past 24 hours. The most reliable reference prices for institutions since 2014 are now published under the CoinDesk brand, trusted globally as the leader in crypto news, events, and data. So it is a very risk-off market right now. Concerns about Fed tapering potentially, debt default of Evergrande in China, which has the markets there a little shook. Lawrence, what's going on?
Yeah, I think right now it is Evergrande. It's the situation involving Chinese commercial paper and creating a risk-off environment, as you said. People just they just want to hold on to whatever they can, whatever cash they can. They don't know how hard they're going to be hit. Let's remember that Bitcoin is still a heavily traded asset in Asia. So anything that affects the Asian market is going to affect Bitcoin. The other thing, too, is let's not forget that the largest stablecoin pushing the entire crypto market, more than half of the trades happening are against Tether. Tether holds a lot of commercial paper. They won't say whether or not that commercial paper is in China. They said they don't own any Evergrande. But if there's contagion in the capital markets in China, that affects the commercial paper in China. And if a lot of it's being held by Tether, which we don't know because they won't have that clarity that people have been asking for the past 3 years, if we don't know what they're holding as assets, well, that Tether might not be back 1-to-1 to the dollar, as people have been warning about for, I don't know, a couple of years now, 3, 4 of them. So, of course,
certainly shaking up the confidence of the markets. Another headwind is the regulatory front. And Emily, Celsius is getting a bit of a crackdown on that regard from the various states in the United States.
Yes, it looks like DeFi, decentralized finance, is increasingly getting into the crosshairs of U.S. regulators, which is quite interesting because DeFi is decentralized and until now has kind of been flying under the radar. But we do have Texas and now New Jersey going after Celsius. We also have various U.S. states going after BlockFi. So this is going to be definitely something to watch in terms of how the DeFi industry develops in the United States.
All right. So with that, let's have a quick look at our crypto markets update.
The Crypto Markets Update is presented by Grayscale, the world's largest digital currency asset manager.
All right, joining us now to discuss the crypto markets is Mathew Sigel, Head of Digital Assets Research at ETF and Mutual Fund Manager VanEck. Welcome to the show, Mathew. So a lot of people waking up this morning not so happy about the way their portfolios are looking. What's going on?
Yeah, thanks for having me. It is a volatile morning this morning. I think we should remember that crypto is still a very high beta asset class, and it's going to get hit when we get a deflationary market shock, whether that's the possible collapse of this China property developer Evergrande, whether that's an inability in Congress to get a debt ceiling agreement done and stimulus dollars flowing throughout the country. All those things are going to hit crypto, disproportionately when it's a deflationary shock. And that's, not to mention the provisions in the regulatory uncertainty that still remains in the infrastructure bill, some of the tax reporting requirements that I think maybe some of the crypto bulls swept under the carpet and declared premature victory on, but some of those will come back into the fore over the next couple weeks as lawmakers get into the weeds on – potentially putting this legislation into law.
All right. So with that, let's have a quick look at our crypto markets update. The crypto markets update is presented by Grayscale, the world's largest digital currency asset manager, VanEck. Welcome to the show, Matthew. So a lot of people waking up this morning not so happy about the way their portfolios are looking. What's going on?
Yeah,
Matt, as I said earlier, a large part of the crypto market is powered by stablecoins. That's what's most of the trades on the exchanges, at more than half, are against stablecoins, particularly one. That one is backed by commercial paper. Should we be worried that such stablecoins backed by Chinese commercial paper potentially, shouldn't we be worried that this is not exactly the greatest market to be in a time of a potential crisis in the commercial paper markets in China?
Well, I think to your point earlier, we don't exactly know what each underlying piece of paper is in Tether's portfolio, but most market participants who hold that asset, do so with the intention to trade it shortly thereafter. So from that perspective, I don't think Tether, with what is it, $68 billion market cap as I glance at the screen now, I don't think that's likely to be the epicenter of any, systemic weakness out of China, where the Evergrande's debts, dwarf Tether's market cap by multiples. So I think that's maybe looking at the wrong source of the issue. I think here we just have general market weakness. The technicals not looking incredible on Bitcoin, regulatory uncertainty that remains and is intensifying with, various states in the U.S. performing their own regulatory autopsies in the absence of kind of a comprehensive framework. So that's pushing, a lot of cryptocurrency investment outside the U.S.
Nonetheless, you are looking at regulators look at stable coins, and particularly they have Tether in their crosshairs. And we're seeing this, the New York Times had an article about it this weekend. This is something that is spooking the market potentially because, yes, while $68 billion market cap is dwarfed by the huge amount of market cap we had in Evergrande, nonetheless, if that's what the underlying position is in other words, if that's what's pushing the crypto markets, if that's the currency of the crypto markets, and if people are afraid of it, why would they want to necessarily trade something that is potentially ultimately backed by Chinese commercial paper? Again, as you said, we don't know, but they haven't exactly denied it either.
Yeah, I'll just pick up your question, which is why would they trade stablecoins? And, the answer is because it's a cheaper and more effective way to transact value globally across the internet. And unless the regulators are going to declare, every stablecoin a security, which I don't think anyone is predicting, then, the private sector is just going to keep innovating around this technology. So, we can debate which stablecoin you want to use to collateralize your trades, right? Personally, I'm more inclined to use U.S. dollar coin as a New York resident, but I don't see a realistic potential for the public sector to eliminate stablecoins. They may introduce their own version of it, their own multiple versions of it. We'll see how the developer community reacts to that, whether they build, exciting applications that consumers want to use. For now, those applications are built on top of stablecoins.
Matthew, switching topics, I know you've just come back from El Salvador, and now with this price crash in a country that has just accepted Bitcoin as legal tender, there are protests, there are technical glitches. Perhaps you can give us some perspective of your experience and what this continued pullback could mean for an emerging market like El Salvador.
Yeah, I did recently come back from El Salvador, spent 4 nights there to try to check out the reality on the ground when it comes to this adoption of Bitcoin as legal tender. I don't think it's too surprising to see some technical snafus with a timeline and execution schedule this tight. But what I found is that, like so many things which have been politicized these days, and what I found in El Salvador was really no different. A small minority of largely political opponents who are, protesting or claiming opposition to Bitcoin because it's something to oppose. But when you ask them more specific questions about technology or about money, they may actually know very little about either. and they may appreciate the fact that cryptographic technologies, may be a balancing technology to maybe minimize their reliance on dollars, which is another currency that they don't have any control over. So, I found a lot of optimism. I found people who recognize the trade-off between risk and return, who often are spending every single penny that they may have earned that day to buy food, and as such, would be inappropriate to expect them to be acquiring Bitcoin or hodling 100% of their assets in Bitcoin. But when you ask them in 5 years, do you think you're going to own some of this? The near universal answer that I received from regular people on the ground was yes.
So could you talk a little bit about how much Bitcoin correlates with just sort of the more traditional markets like the stock market? In the crypto community, we tend to talk about Bitcoin like it's this really unique asset, but often it sort of tracks the ebbs and flows of the stock market.
Yeah, it's a pro-cyclical asset. The historical correlations show that, it moves more with risk-on assets like the S&P and NASDAQ than, it does with many other, more risk-off assets like treasuries. I think that's understandable because it's underpinned by an innovative technology that is, whose adoption will move along with the economic cycle to a certain extent, because now, we need companies to invest and put resources into scaling cryptocurrencies. But, for now, this is kind of a high risk, high return asset class that will trade with, other assets like equities, but with higher volatility. Now, as that matures and we start to see this asset class take on some more characteristics of the fixed income market, a lending and borrowing ecosystem, sometimes built around DeFi, sometimes built around centralized exchanges, that should over time lower the volatility of this asset. But, as I look at it now, it's still 2x the vol of the S&P. So, we should expect disproportionate moves on big risk off days like today.
All right, we'll wrap it there. Mathew, thank you very much for your analysis on the market today. That was VanEck, head of digital assets research, Mathew Sigel. Coming up, we'll have a check-in on Asia as well as EY's partnership with Polygon.
When we say we want to reimagine money, it turns out we're going to the heart of the matter. Imagination has always been a key part of what money is. Imagination in the form of cultural creativity is also something that the cryptocurrency community has in spades. And to the outsider, that can be a reason to dismiss it as frivolous, as something built on nothing. To dismiss it for these reasons, though, is to ignore